Samsung, Philip Morris International, MasterCard and Louis Vuitton are amongst the multinational stocks favoured by international wealth manager Sanlam Private Investments. Peter Fourie is head of global equities at the company. He's based in London. He joins us now to talk a little about those stocks. And I suppose the interesting thing, Peter, just to begin with, is there are alternatives on the Johannesburg Stock Exchange. But the advantage that you have is you don't have to invest in BAT. You can in fact go for something like Philip Morris, or necessarily in Richmond. You can look at Louis Vuitton. So it's good to be in London.
Yes, indeed. If you look at Louis Vuitton and Richmond, for that matter, they actually both trade at a discount to other stocks within the luxury group, like Prada International, or like Remy Cointreau or Pernod Ricard. So we like both of them, but for our overseas clients, we liked Louis Vuitton throughout the year, and as it turns out, this month has been a very, very strong performance for the stock. The stock's up 14% this month. So some of the short-term value that we saw in the name has been diminished, but we still like the balanced portfolio of the assets that LVMH have in the long term, and the exposure to Asia in particular.
And the comparison between British American Tobacco, or BAT as we know it here in Johannesburg, and the one you favour, Philip Morris?
Yes, so Philip Morris, the stock's been going sideways for roughly a year now, and we like the name because it's more exposed to areas like Indonesia and the Philippines, where there's been some short-term negative news flow on excise duty increases. So in terms of the valuation, we actually find that for the first time in quite a while, Philip Morris, who also have large emerging market exposure like BAT, is actually trading at a slight discount to BAT, and that's the reason why we prefer Philip Morris right now.
Peter, we have news, or we understand that Glencore will be listing on the Johannesburg Stock Exchange soon. There's a lot of pent-up demand for the stock here. Is it one that you've spent much time looking at from London?
Glencore is not an easy stock to value. I mean, we like to invest in businesses which have a very clear business model. In terms of Glencore, of course, a large part of the profits come from the trading side of their business, which we find difficult to value. So in terms of the earnings profile, clearly, along with the ex-strata exposure from the merged business, you have potentially quite a cyclical business. So it's important that you get your timing right when you buy into these names. I think the jury is still out how the integration's going, although from memory the management did confirm that they're targeting more cost savings than what they originally aimed for. If, however, I compare a stock like Glencore to something like MasterCard, MasterCard to me is clearly in a secular growth industry, dominated by 2 or 3 big players, along with Visa and American Express, and we just find the long-term secular growth opportunity much more compelling than, for instance, a stock like Glencore, which is ultimately exposed to the commodity cycle, of course.
Sitting in London, you have an opportunity to play different markets around the world, and you've said that you've been switching a little out of the United States market, looking for opportunities elsewhere. But what about Africa? Are there many non-South African business opportunities that you look at that appeal?
We continue to prefer to get exposure through Africa on an indirect basis. Of course, for South Africans, they can get that through the ShopRites and the Remgros. But if I look at some of the names we own, like Nestle, of course, and MasterCard for that matter, MasterCard still have a massive potential in areas like Brazil, Africa, and India to essentially bring a business model to those areas of the world where cash transactions still dominate. Versus the likes of the developed world, where credit card transactions already quite in the order of the day. So in terms of our African exposure, we're very happy owning names like Colgate, Unilever, and Nestle to get our exposure in Africa. And of course, Africa and places like India will continue to be growth drivers for them in the long term, although in the very short term, of course, when you look at earnings revisions, at the moment that's negative because of their emerging market exposure. But as these stocks pull back, as we've seen the last week or so, it will create opportunity again to pick up these stocks for those investors who believe in buying for the very long term.
You made some interesting points in the research report that you sent out, not least that you're moving out of America, where the growth this year has been 20%, and looking more at a market like Hong Kong, where it's virtually unchanged from the beginning of the year. Now, a stock in Hong Kong that has the whole of South Africa enthralled is Tencent, which is 38% owned by Naspers and has helped the Naspers share price. Have you done much research into that one, and would you consider investing there?
For Sanlam Private Investments, we did and we continue to like Naspers, of course. The CIO in South Africa has spoken about that quite often. So, from our point of view, Tencent is a great business, a very good return on capital, great management team. It always just seemed a little bit too expensive for us to take the plunge. Instead, what we found in Asia is a name like Samsung Electronics, where we think there's big value support with the stock trading at close to book value levels. They still have a large opportunity in China, where they've taken the lead by quite a distance from the likes of Apple and Nokia. So that's how we get our exposure. We think that if you own a name like MasterCard, perhaps Visa one day, if it gets to a level where we could buy that, that gives you enough exposure in a portfolio for valuations that are never that cheap, but where you don't want to end up with a portfolio that's very, very expensive. So, as I said, Tencent just didn't quite tick off for us on the valuation parameters.